Dividend stocks versus index funds. Put the same $500 a month into each for 30 years, and one of them can leave you roughly $250,000 to $350,000 richer. Here's the twist. It's usually not the one paying you the dividend. We did the math, so you don't have to. This is one of the most emotionally loaded debates in personal finance. On one side, dividend investing, buying funds like SCHD or VYM, that pay you cash every quarter, income that feels like free money landing in your account. On the other side, plain, broad index funds like VOO or VTI, where you mostly just watch the number go up. The question we're answering is simple. If your goal is to end up with the most money, which one actually wins? To answer it, we're going to run the total return math over 30 years, expose what a dividend really is at the mechanical level, and measure the tax drag dividends quietly create in a taxable account. A note on the numbers: tax brackets and IRS thresholds are official figures. Fund yields and trailing returns are industry data that shift constantly, so treat every rate here as illustrative, not a headline. And the 30-year projections are modeled scenarios, our own math using stated growth rates. They show the mechanism, not a guarantee. Let's start by killing the biggest myth. A dividend is not free money. Here's the mechanic almost nobody explains. On the ex-dividend date, a stock's price drops by roughly the amount of the dividend. Picture a $100 stock that pays a $2 dividend. The instant that dividend is paid, you own a $98 stock plus $2 in cash. Your total wealth? Exactly $100, unchanged. You didn't gain anything. You moved $2 from one pocket, the share price, into another pocket, your cash. This is confirmed by investor.gov and Schwab. It's a mechanical accounting event, not a bonus. So when a fund advertises a fat yield paying you income on top of growth, that framing is wrong. The payout is a partial withdrawal of capital you already owned, which leads to a powerful idea economists call homemade dividends. If you own a plain index fund that pays little or nothing and you want cash, you just sell a tiny slice of shares. Economically, that's identical to receiving a dividend. Same result, your wealth drops by the amount you took out. But in this matters, you chose the timing and the amount. A forced dividend gives you no such choice. Hold that thought, because that lack of choice is exactly where the tax bill comes from. So if the dividend itself isn't a gain, what actually matters? Total return, that's price change plus dividends combined. It's the only scoreboard that counts. And here's where it gets interesting. Over the past 10 years, the S&P 500 fund VOO returned about 15.4% annualized. The leading dividend ETF, SCHD, returned about 12.4%. In cumulative terms, that's roughly 320% growth versus 232%. Put $10,000 in each back in 2015, with dividends reinvested, and VO grew to about $33,000, while SCHD grew to about $27,000. A separate backtest from 2016 to 2025 tells the same story. A dividend-tilted portfolio compounded at 9.43% a year, while a total market blend compounded at 10.49%. That's about a 1% gap per year, and over decades, 1% is enormous. Now, one honest caveat: trailing returns depend on the decade you measure, and past performance is not a promise. But the pattern is consistent, and there's a deeper reason behind it. Dividend fans will say, but dividend stocks have a premium. They outperform. Let's look at what the research actually found. A study published in the Financial Planning Association's journal broke high dividend outperformance into its underlying drivers. The result was striking. The outperformance came from the value factor, the tendency of cheaper established companies to do well over time. The yield characteristic itself, the actual dividend, detracted from performance once you stripped out the value tilt. Read that again. Yield actively hurt returns. That's the opposite of the dividend aristocrat marketing. So when a dividend fund does well, it's usually doing well because it happens to hold solid value companies, not because it pays a dividend. You can often capture that same value exposure more cheaply without forcing the payout. And there's a related finding. Dividend growth beats high yield. Since 2005, the dividend aristocrats, companies that grow their payouts, beat the Dow Jones Select Dividend Index, which chases the fattest yields. Reaching for the biggest yield has historically underperformed. Sometimes a sky-high yield is a warning sign, a company in distress, what investors call a yield trap. Now, the part that quietly costs you the most, and it only shows up in a taxable brokerage account. In a taxable account, every dividend you receive is a taxable event. That same year, whether you wanted the cash or not, you have zero control over the timing. Compare that to price appreciation in an index fund. That growth isn't taxed until you decide to sell. You control the timing and therefore the tax bill. Let's put numbers on it. Qualified dividends are taxed at the same rates as long-term capital gains, 0%, 15%, or 20% depending on income. That's official IRS treatment. A broad index fund with a yield around 1.1% creates a tax drag of only about 0.2 to 0.3% a year. But a high-yield dividend fund throwing off an extra 2% of yield, taxed at 15%, adds roughly another 0.3% of drag every single year, unavoidably. And here's the compounding sting. A drag of just 0.27% a year compounds to roughly 10% of your entire ending balance over 40 years. You're not losing a little, you're losing a slice of everything that money would have become. One more subtlety people miss. Even if you reinvest every dividend in a taxable account that money was taxed first, then reinvested it, pure price growth skips that annual toll entirely until you sell. Let's bring it all together with the headline calculation. We modeled $500 a month for 360 months. 30 years, that's $180,000 of your own money contributed, either way. Scenario 1, the broad index fund compounding at 10.49%. Ending balance, about $1,255,000. Scenario 2, the dividend fund at 9.43%. Ending balance, about $1,002,000. Now apply the taxable tax drag. Trim the dividend fund to 9.13%, and it lands around $941,000. Same $180,000 in, a difference of roughly $250,000 to $315,000 at the end. And notice that gap didn't come from bad luck or a market crash. It came from a 1% annual return gap plus tax friction, grinding away silently for 3 decades. Double the contribution to $1,000 a month, and the gap doubles to over $500,000. That's the accounting illusion in one chart. The investor who felt like they were collecting income the whole way can finish $250,000 behind the one who just held a boring index fund. Now, to be fair, because this channel is about the data, not a sales pitch, dividends matter enormously, but not in the way the marketing suggests. According to Hartford Funds, since 1960, about 85% of the S&P 500's cumulative return came from reinvested dividends and compounding, and roughly 40% of total return since 1930 came from dividends. That sounds like a case for chasing yield, but read the fine print. The magic word is reinvested. It's an argument for reinvesting dividends, not for spending them and not for buying the highest yield fund. In the lost decade of the 2000s, the S&P's price return was actually negative, yet dividends added about 1.8% a year, cushioning the pain. Again, that rewards reinvesting, not yield chasing. And there's one more real advantage, and it's behavioral, not mathematical. Nobel laureate Richard Thaler's work on mental accounting shows that dividend investors tend to think, I spend the income and never touch the principal. That mindset helps them hold through crashes instead of panic selling. A slightly worse math outcome you actually stick with can beat a perfect one you abandon at the bottom. So here's your decision framework by situation. If you're young, accumulating, and have a long horizon, the default winner is a broad total market or S&P 500 index fund, VTI or VOO. Maximize total return and minimize the taxable dividends you just have to reinvest anyway. If you're in a high tax bracket, 32% or above, and investing in a taxable brokerage, avoid high-yield dividend funds in that account. Those forced dividends get taxed every year with no control. Keep any dividend-heavy or REIT funds inside an IRA or a 401k, where the tax drag disappears. If you're a retiree who needs cash flow, this is where it gets personal, because the choice is mostly behavioral. If dividend income is what keeps you from panic selling in a downturn, a modest dividend tilt is a legitimate hedge. Otherwise, a total return approach with a systematic 3 to 4% withdrawal usually leaves you wealthier and better diversified. If you want the best of both worlds, lean toward dividend growth, VIG or DGRO, rather than high yield. Historically higher total return, lower yield trap risk. And one threshold worth knowing: if your taxable income is under the 0% qualified dividend cutoff, about $48,475 single or $96,950 married filing jointly, your dividend tax drag is essentially zero, and the tax argument mostly disappears. But no matter which camp you're in, while you're still building wealth, reinvest every dividend. That's the single move that captures the 85% cumulative return effect the data keeps pointing to. If this made the numbers click, hit like and subscribe. It genuinely helps us keep doing the math so you don't have to.